Chapter. We're talking real money.
Boy, it's the day Tom's grandsons look forward to all week. Yes, it's Q Day. We've changed the name. It's not Friday anymore. It's Q Day. Q needs a day. There's really not much that starts with the letter Q anyway, except questions and queries, and quilts and queens, and quotes, and qubits. Wait a minute. No, that's CU, isn't it? Never mind. Anyway, it's Q Day, which means it's question and answer day. Here for Tom and his grandkids and all of you. And thank you all so much for all the questions you have sent in at talkingrealmoney.com on the contact form, and you spoke them into your mic on your computer. Do you know your mic on your computer could conceivably sound as good as this one? It could. You got to buy a $1,000 mic and hook it to your computer through an interface that's going to cost you a few $100. But it can. Computer mics can sound really, really good. And so it makes for kind of a high-quality show, which I appreciate. And, of course, you send in great questions. So we've got a bunch of those today because we still have a decent-sized queue. Oh, Q word. Ho, found another one. We still have a decent-sized queue. It's not spelled C-U-E. It's Q-U-E-U-E. It's very British. Actually, it's probably something else. I keep digressing again. Okay, anyway, questions. Send them in, talkingrealmoney.com. You can also call Saturdays, 855-935-TALK. And, let's just go to the first question.
Hi, guys. This is Betsy from Minnesota. I have a question for you. My husband and I are in our middle 60s. We are retired. We do have quite a substantial amount in our Roth IRA, and we're doing Roth conversions regularly. My question is, what are the best funds for a Roth? Right now, I've got AVUV and VOO. I'm considering adding AVGE for international exposure just to the Roth. But I would like your ideas. We do not plan on taking the money out for at least 6 years.
People in Minnesota are nice. You just sound very nice. You're very aggressive. Wow. 6 years, AVUV, small cap value. AVGE, yeah, you're going to get some international, but adding that to the portfolio is going to give you just a teeny tiny bit of international. You might be better off. It just seems like it would be a lot simpler to eliminate AVUV if they're in the Roth and just replace it all with AVGE, because that gets you some of AVUV, that gets you some of VOO, which is the S&P 500, that gets you then a higher international exposure, and it gives you a fund that is going to aggressively rebalance among equity asset classes. However, make sure you've taken the risk quiz at talkingrealmoney.com and that you're comfortable with this degree of risk. I mean, even with just AVGE in the portfolio, which I think would be better, I just think it'd be less confusing, you could suffer a 50% loss in a year. You could. Make sure you're okay with that you're certain you won't change your behavior, because we often think we're emotionally stronger than we end up being when all of the headlines say, well, the world is coming to an end. Sorry. You missed all the good times. It's all over from here. And that's always the way it sounds when we have a big downturn. It always sounds like it's the end of the world as we know it. And so far, it hasn't ended. And worse things have happened than stuff lately, even though we think it's horrible. Anyway, thank you so much. Appreciate the question. Let's go to the next one.
Hey, Don and Tom. This is Jesse from Seattle. I've called in a few times before and always love hearing your perspectives. I've got a question today about an ETF with the ticker symbol CPAG. I listened to Med Faber's podcast with the CEO of the company that issues the ETF. They're called FM Investments, F/M. The ETF looks like it tracks the Ag Bonded Index, but it uses some clever trading to convert the income that's generated by the bond fund into capital appreciation, which they claim that will help defer tax obligations by, making it into long-term capital gains. But the fees on the ETF are are like 0.45%, which seems pretty high for an index fund. What I guess I'm wondering is if the fees are worth the tax savings in a taxable account. I'm sure that would depend on your marginal tax rate, but I'm wondering if the juice is worth the squeeze, and what you think about this approach for taxable accounts in general. I keep some medium-term funds in a taxable brokerage, but I currently use a low-cost bond index fund. So yeah, just wondering what your input or your perspective might be on that particular fund. Thanks so much. Appreciate your show and look forward to your response.
Methinks me smells a gimmick. I think it's a gimmick. Sounds very gimmicky to me. I'm and the expense ratio, come on. Really? A bond fund that's almost 0.5%? When, what is BND? 0.03%? Yeah, it's the U.S. Aggregate Bond Fund, but I thought it might be worth checking out. So I did a little research. They've got a very complex strategy for turning some of the potential income into capital gains, but not all of it. And so did some math, rough math, assuming the same return on both this fund and BND, of course, with the lower expense ratio. So, of course, your net return before taxes is going to be higher for BND. The only time when the CPAG might make sense is if you're in the 35% bracket. Because after you calculate the capital gain, the income tax, there'll be an income tax on some of the income coming off of CPAG. Some will defer as capital gains. But at the end of the road, when you cash out, you pay the long-term capital gains tax, because you're still going to pay a tax on that eventually. It's just at long-term rate. The net after-tax return that I came up with after 10 years is, again, assuming 5% per year, 35% marginal rate. The difference between them is CPAG, the CPAG, would effectively return just over 3.5%. While in the 35% bracket, BND would return 3.25%. So it's a little less than 0.3%, a little more than 0.25% difference. Add the gimmick, add the complexity, add the potential for problems that, we human beings have a real issue foreseeing potential problems, particularly when we've invented a product. We don't see what the problem might be down the road until the problem happens, and then we go, I guess that was a problem. So would I touch this? No. When there are simpler alternatives, even in the 35% bracket, which I'm not, and I make decent money, I wouldn't touch it. Anything below the 35, definitely not. It's just a no-brainer not to use it. Thanks so much for the question. We've got more, lots more that came in at talkingrealmoney.com. Plus, hey, it was a light weekend last weekend, so this weekend, give us a call, 855-935-TALK, to talk one-on-one with us on our Saturday radio show, 3 to 5 Eastern Time. But let's go back to one of the recorded questions. Here's the next one.
I have an old 403B where I worked for that company, contributing to that 403B from roughly 2000 to 2005. And for every dollar I put in to what was basically an index fund with relatively low fees, although not rock bottom, is now worth $10. And we bought our house in 2005. And for every dollar we put into the house in terms of the purchase price, that's now worth $2.5. So I know the timelines don't match up exactly. The house at 20 years, the 403B at closer to, averaged out over probably 22 and a half. But I know I've heard you talk about the different returns for real estate over time. And I just happen to think about this example with these two different assets with roughly the same amount of time on them, having quite different return results. So I was wondering if you would speak to whether you think that's typical or an aberration. Thanks. Love the show.
I believe that's typical. On a national level, that's very typical. As a matter of fact, your return may be slightly... No, it's about right. That's about right. That's about right for that time frame. Real estate has... And there's a great track record on real estate. We have data going way back on real estate. Going back over 100 years, Case Shiller found that homes made like 1% over inflation. Equities over a similar period have made like 4 or 5% over inflation. So 4 or 5 times more. So this is indicative of homes are not great investments. I've been saying this for a long time. They appear that way because people put so little money down. And if they're in an area where prices have skyrocketed, the return on the capital put into the house can look really good. You put $10,000 down, and in a couple of years, you make a $100,000 profit. It appears you just got 10 times your money, but it's leverage. You did only because you leveraged that money. Now, in a downtrending market, you would have been upside down in that house with only a $10,000 reduction in price, or $12,000 or $11,000. So real estate's not what most people think it is in terms of an investment. Lifestyle, different story entirely. I've purchased and lived in houses for a long time. Let's just say a long time, 45 years or so. And that's a lifestyle choice. Never really made out like a bandit. Made a couple of bucks here and there. But, when you factor, and Tom and I did this. We did this with his house recently. Factored in all of the expenses of maintaining the house and improving the house, fixing it. And I think his return ended up being less than 2% a year. So, yeah, this is pretty typical. Let's go to the next question.
Hi, Don. I've got an HSA question for you. I'm 51 years old, live in California, and have been contributing to a health savings account for about 8 years. I'm treating the account as a supplemental retirement account, and I'm not reimbursing myself for current expenses. The plan is to let it grow another 20 years or so before starting to use it. I recently decided I should switch to a more aggressive portfolio since I don't want to touch it for so long. And I figured since it's a tax-sheltered account, I could sell without tax implications. However, I just recently learned that California is one of 2 states in the nation, along with New Jersey, that doesn't recognize health savings account as tax advantaged and treats them like a regular taxable brokerage account. Are you familiar with this? Does this mean that I can't sell my existing funds and buy new ones without paying capital gains tax to California? I don't even know how to figure out what my basis and gain is. That information doesn't seem to be available at the custodian's website. That custodian is Optum Bank. And furthermore, should I have been paying California tax on dividends over the last 8 years? I don't get any 1099 forms or anything. Just curious if you've dealt with this issue of health savings accounts for California and New Jersey residents, and if you have any advice. All right. Thanks for everything you do.
Yep. As far as California is concerned, a health savings account is nothing more than a brokerage account wearing scrubs. It's nothing special. It's just another investment, and you get taxed on it. And the problem is some HSA custodians don't provide a separate statement for California. So you may have to actually estimate your capital gains and your taxable earnings. You got to file a return on it. No, there's no deduction. There's no, you owe state tax on gains on income. I'm sorry. And there is no way around it. If you live in California and you have an HSA, it's treated like a normal investment account. What else can I say? Except send along your question at talkingrealmoney.com. Either speak it or type it into the contact form. And we've got more. I think 2 more. Here's the second to the last.
Hi, good morning. This is Nathan calling from sunny coastal Georgia, and I just had 2 questions for you today. I appreciate you taking my question, and I thank you for all the education I've gotten through your podcast over the past couple of years. My first one is pretty simple in regards to my wife and I each have IRAs, and we are both government employees and both have TSPs. Our investment mix between those is 60% large cap, 20% small cap, and 20% international. And that's the same between all of our accounts. We're currently using VT, VTI, and VB. And then the TSP has the equivalent C fund, S fund, and I fund. I've heard you speaking recently about the Avantis products and the difference in return over the past 10 years. I don't remember the exact specifics, but I was wondering if you could talk to whether or not a case could be made for switching from the Vanguard to the Avantis based off of that better performance over the past 10 years from the Avantis products.
I hate to base anything on looking back because it's not indicative necessarily of future outperformance. However, that being said, Avantis and Dimensional have a tilt, a factor tilt that leans more towards small cap and value stocks than you're going to get with your VT, VB, and VTI combination. You're just not going to get a small value tilt. You're giving yourself a small tilt, but there's no value tilt. And historically, that has actually, even though it didn't do it for the past 20 years, that has shown to provide greater returns over longer periods of time. Who knows what the future brings? We don't know. However, that said, even though VT and VB and VTI are really cheap and AVGE is a little bit more expensive, not a lot, I don't think it's, and here's the other thing is that if you could just use AVGE and get rid of VT, VTI, and VB. Just have that one fund and have large, small, value, growth, and international all in one fund where you don't have to do anything. And to me, that's probably worth 0.12% a year or whatever the difference is overall. So I'd certainly consider it. It would simplify the portfolio. And if you just keep Vanguard, get rid of VTI, get a better international allocation, even though VB doesn't give it to you, but at least that gives you a small tilt. But I think just AVGE would make a lot of sense. And now on to the second part of your question, meaning basically listeners get 7 questions today. Hey, bonus.
And then my second question is not something that I'm considering, but it seemed really interesting to me. I've seen these advertisements for investment apps to where you can copy the trades of politicians or other investors. And while I personally think this is not a smart thing to do, I was just wondering if you could speak to that and give your opinion on it. It just seemed really interesting to me. And I'm pretty sure I already know generally what you're going to say, but just seemed like an interesting thing for me to ask you. Well, I appreciate your time. I hope you all have a great day.
These have been around for a while. It's another silly idea. It's just silly. And there are some things wrong with it. First, the expense ratio. These things are like 1% a year compared to 1/10 or 0.2% a year for 0.25 for AVGE. So they're expensive. And here's the problem. They're also very small portfolios generally, but here's the problem. They're relying on forms that are filed after the fact, way after the fact, after the purchases have been made. And if somebody's operating on insider information, albeit they think it's legal, it's not, but it's Congress. Then they've taken most of the juice that is in those trades already for themselves, leaving very little for you and the other plebes out there riding their coattails. So my expectation would be that the returns wouldn't be all that impressive. And looking at the returns historically, they've made money, but they haven't outperformed the market by all that much, considering the much higher level of risk that they provide. So, no, there's another gimmick. Silly ideas. Now we are coming up on officially the last question of Q Day. Here it is.
Hi, this is James from Virginia. Just a quick question for you. I know you guys are big on Charles Schwab as a custodian. Currently, I have pretty much everything with Vanguard, and I'm hoping you can shed some light on my question with them. Right now, I have their money market fund as my settlement fund, which I find advantageous, just in case dividends pay out, or, maybe I transfer some money into my account and don't do something with it for a few days. It's still being actively invested in something with a pretty good rate right now. They've been really advertising this Cash Plus account as an alternative to their money market fund. As far as I understand, it's just like a high yield savings account that really has a lower percentage, a lower rate of return compared to their money market fund. So I'm just trying to figure out what the advantages of that would be. Again, they seem to be really advertising it pretty heftily, but when I look at it, I think I should probably just stay in the money market fund as my settlement fund. If you could just shed some light, I'd appreciate it.
The only advantage, really the only big advantage that I can see, the Vanguard money market funds are very, very safe. They're just not guaranteed safe. They've never broken the buck. They've never lost anyone money in all the time they've been around, but they could. I don't think they will, but they could. Whereas the Cash Plus account is an FDIC. I just leave that in. Why should I edit that out? I stumble. I'm human. An FDIC insured account. So you do have a guarantee that should there be problems with the institution behind the Cash Plus account, you will get all your money back someday. I mean, if it's a terrible meltdown in the economy, it could be someday. But it's inherently safer. Therefore, the yield is slightly lower because, generally speaking, and of course there are exceptions, but this whole concept of risk and reward being intertwined is generally true. A higher return usually exists for a reason. People require a higher return when they feel like they're taking on a little bit more risk, even if it's practically non-existent. So that's the difference. I would stick with the money market. I think you're fine. I can't guarantee you're fine. But even FDIC, come on, it's a guarantee. It's a government guarantee, so it's as safe as you can get. But could stuff happen? Yeah, it could. We don't get any guarantee. Well, we do get one guarantee. Once we've been born, we get the guarantee that we will be unborn someday. We're just going to end. Sad as that seems. So I'm trying so hard to leave a legacy before I go. Hey, thanks so much for being a part of the podcast. I truly appreciate you being there. I do. And please call us on Saturdays on our radio show, 3 to 5 Eastern Time, 855-935-TALK, 855-935-8255. Oh, and I've been meaning to mention something, and Tom will just give me a hard time, so I'm just gonna mention it. For fun, not for profit, trust me. I do some other podcasts like Lit Reading, which is classic short stories that I read, old ones, public domain ones. Then I have one called Read a Storis, which is read a story to us, but it's contracted. And that's for kids' stories. And then recently I started doing a little short story writing because I've read so many of them, and I used to love writing them when I was a kid. And so far, I've got several of them up at my new website, my new podcast called New Tales Told. New Tales Told. You can find that on your favorite podcast services. I think most of them. If it's not on yours, drop me a note. Let me know. But I think it is. I think it's pretty much everywhere. I know it's on Apple. It's on Spotify. So check it out. Most of the stories, most of the older ones, they're murder stories, murder mysteries, murder stories. But I'm branching out into some other things too because it's fun. Turns out it's really fun. I'm having a good time. So check it out because the only way it's worthwhile is if people actually hear what I've done. So I'm hoping you'll go listen, and if you like it, you'll listen again and leave a nice review on Apple Podcasts. Okay, that's it. Send in your questions at talkingrealmoney.com on the contact form. If you'd like to meet with one of our Appella advisors, we love to provide everyone. We truly like providing everyone with help. I mean, Tom loves doing this. He absolutely adores taking your calls. And you can set up an appointment to talk to him or any of our advisors for free. And I promise they're not going to pitch you stuff. You're not going to get pressed into doing something. You're just going to get help. You want somebody to look at your portfolio and go, oh, that's a hodgepodge. Sure, we'll do it. Just go to talkingrealmoney.com and click on Meet an Advisor. And please, again, call the show on Saturdays, 855-935-TALK between 3 p.m. and 5 p.m. Eastern, because we are everywhere talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.